Welcome to Breaking News to Trading Moves. Today we are looking at a very specific transaction in the utility space.
Right. It is one of those headlines that, might just scroll past on your terminal, but
But when you actually stop to look at the mechanics, it tells you a lot about where capital is flowing right now.
exactly. It reveals the underlying currents. And we are talking about the buyout of TXNM Energy.
That is right. TXNM Energy has been in the process of a buyout by Blackstone Infrastructure.
It is an all-cash deal valued at roughly $11.5 billion.
And that $11.5 billion figure, just to be clear, that includes the assumption of their existing debt.
It does, yeah. And the specific update hitting the wires today is that they have cleared a major regulatory hurdle.
A major one. The U.S. Federal Energy Regulatory Commission, or FERC, has officially given the green light.
Which is usually the hardest part. And on top of that, the waiting period for the Hart-Scott-Rodino antitrust review has expired.
So it is essentially a double barrel of approvals.
It really is. And, in the utility M&A world, getting that FERC approval is often the tallest wall to climb.
Let us break that down a bit. I think people hear a phrase like regulatory approval and their eyes just glaze over entirely.
Oh, absolutely. It sounds like pure paperwork.
But for a trader watching the tape, this specific approval changes the math on the stock immediately.
It does. It changes everything about how the stock trades. Because when you see approvals like this land, the immediate reaction in the market is all about the compression of deal risk.
Right, the arbitrage spread.
Exactly. You have to remember that until these approvals actually come through, the stock of the target company,
TXNM in this case.
right, TXNM trades at a discount to the offer price.
Because there's always a chance the government just says no.
There is always a chance. The market essentially prices in the probability of failure. The current stock price, prior to today, was basically a probability calculation.
It reflects the skepticism of the traders.
Precisely. But once you get FERC on board and that antitrust waiting period runs out, that probability of failure drops precipitously.
So the discount disappears. Or at least it shrinks dramatically.
Right. The market stops worrying quite so much about if the deal will close, and it starts trading based on when it will close.
The risk premium just evaporates.
It shrinks, yes.
Yeah.
The stock price moves much closer to the acquisition price because the uncertainty has been removed. It's a completely mechanical adjustment by the market makers.
Now, this is not just about TXNM shareholders getting paid out, is it?
No, not at all.
This approval functions as a signal for the broader market.
It is a major regulatory signal. For a while now, there has been a lot of hesitation regarding large infrastructure-style utility deals.
Because investors were worried that federal reviewers might block them.
Yes, or that they might impose conditions that just make the economics fall apart, specifically around things like consumer rates and ongoing oversight.
There was a real fear that the federal government was going to take a hard line against private equity coming in and buying up public utilities.
Exactly that fear. But this approval suggests that there is a defined path forward. It proves that these deals can clear federal review without triggering a complete blow-up over rates.
It tells the market that private capital can indeed buy regulated utilities, and the federal government is not automatically going to stop the transaction.
Right. It is not an automatic red light. Which brings us to the concept of sector rotation.
Because when you see a deal like this proceed smoothly, it completely changes the way investors look at the entire sector.
It nudges sentiment toward what we generally call regulated, contracted cash flows.
These are your classic defensive plays.
They are. When the regulatory environment looks stable, investors feel much safer moving their money into these steady utility names.
And obviously, if they are moving money into utilities, they're likely taking it out of somewhere else.
That is the rotation at work. They tend to rotate out of the more volatile cyclical power names and into these regulated, boring, steady names.
But we can get into the losers of that rotation in a minute. Let us look at the winners first.
Let us start with the obvious one.
The direct beneficiary, the deal target itself, TXN Energy, ticker TXNM.
Right. TXNM is the first winner. It has been specifically de-risked by this regulatory news. The path to that $11.5 billion exit is much clearer right now.
But the trade often extends way beyond the target itself.
It does. You have to look at the sympathy plays.
I love talking about sympathy plays. Explain how that works here.
Well, when one deal clears the hurdles, investors immediately look around for similar companies. They start pricing in M&A optionality across the board.
Essentially, the market thinks, if Blackstone can buy TXNM, who else can be bought?
That is the exact thought process. It creates a clearer regulatory playbook for these acquisitions so other companies look like viable targets.
So who makes up that sympathy list? I know we are looking at companies like Avista, ticker AVA.
Avista is a very classic example here. It fits a remarkably similar profile to TXNM.
In terms of size and structure.
Yes, it is a regulated, mid-sized utility. If the federal regulatory hurdles are lower than we previously expected, AVA suddenly looks much more attractive as a potential target.
So you might see AVA catch a bid just because TXNM got approved.
Exactly. It is a repricing of the probability that Avista could be the next one acquired.
Another one often mentioned in this specific basket is OGE Energy, ticker OGE.
OGE fits the mold as well. These stocks often see a slight price increase purely on the sympathy of the news.
Investors are basically placing chips on the idea that the for sale sign is easier to hang up today than it was yesterday.
Precisely. Okay, so those are the utility targets. Let us pivot to the other side of the table.
Buyers.
Yeah.
Money behind the deals, the alternative asset managers.
Right, and the news is obviously very positive for Blackstone, ticker BX.
Because it validates their entire strategy.
Blackstone Infrastructure is making a very specific bet here. Securing these federal approvals supports their core thesis that private capital can actually deploy large amounts of money into regulated infrastructure.
And for a firm like Blackstone, proving you can simply deploy the money is almost as vital as the return itself.
Oh, it is the absolute engine of their business model. They raise massive funds from limited partners to buy physical assets.
And if they cannot close deals because of regulators, they just cannot deploy that capital.
Exactly. If the money sits there, they are not generating the returns or validating the fund. This approval shows their LPs that the machine actually works.
And Blackstone is certainly not the only one playing in this sandbox. You have KKR, ticker KKR.
KKR is heavily involved in infrastructure as well.
So when Blackstone succeeds, it reinforces the narrative for KKR too.
It does. It shows their investors that this strategy is viable across the board. It helps with fundraising.
Because if you can show a track record of getting deals closed in a tough sector, it is vastly easier to raise your next fund.
Exactly. A win for Blackstone really is a win for the asset class.
And we definitely should not forget Brookfield Asset Management, ticker BAM.
Right. BAM is the other giant in this particular space. This really is a collective win for the entire private capital and infrastructure narrative.
It proves that the regulatory friction, while it is definitely present, is manageable.
And that manageability is a key selling point for all these firms when they go out to raise capital.
Now, there is a third group of winners that I think gets overlooked sometimes in the financial press.
The people who actually do the work.
Yes, the people who build and fix the stuff.
Yeah.
The infrastructure contractors.
This is a second-order effect, but it is a very real trade.
Let us walk through the logic there.
Well, when a large asset manager like Blackstone takes over utility, they are not doing it to strip it down and sell the parts.
Right, that is an old private equity stereotype.
Exactly. Usually the investment thesis in this space involves heavy capital expenditure.
They want to improve the asset.
Right. They want to upgrade the aging grid, harden reliability against storms, modernize transmission lines.
You do not buy a utility to let it rust.
No, you buy it to build the rate base.
Explain the rate base quickly for the listener.
Basically, a utility is allowed to earn a regulated rate of return on the capital they invest in their infrastructure. So the more they build and improve, the more profit they are allowed to generate.
So that means a ton of construction contracts. Who gets those calls?
We are generally looking at companies like Quanta Services, ticker PWR.
PWR is the really big player here.
They are. If the TXNM deal closes smoothly, it supports a very steady investment outlook. It means the checks will keep clearing for grid modernization in that region.
Blackstone is going to want to improve the asset, and Quanta is exactly the type of company they hired to do the heavy lifting.
Exactly. We also have MYR Group, ticker MYR.
MYR operates in that exact same ecosystem, right?
Yes, transmission and distribution maintenance. A stable ownership transition for TXNM implies long-term stability for the vendors servicing their grid.
And the third one is EM Core Group, ticker EME.
EME as well. You have to understand, these contracting companies thrive on certainty.
They want to know that the utility owners have a long-term plan and the actual capital to execute it.
Right. Private equity ownership can sometimes offer that clear, multi-year capital deployment strategy.
It effectively removes the quarterly earnings pressure from the utility.
Exactly. A public utility is constantly worrying about their quarterly earnings per share.
which might make them delay a big maintenance project.
Right. But a private owner like Blackstone has a 5 to 10-year horizon. The timeline for the capital spend expands, which is incredibly good for the contractor's project backlog.
Okay, so that thoroughly covers the winners. But as you mentioned earlier, a sector rotation implies that capital is actively leaving somewhere else.
Right. It is a zero-sum game in a way.
Let us talk about the losers here. We mentioned earlier that money moves away from cyclical power names.
This is the flip side of the flight to safety we discussed.
If investors are getting more comfortable with regulated rate-based earnings,
They might trim their existing positions in the merchant generators.
explain the specific difference quickly for anyone who does not watch the power markets daily. What makes a merchant generator different from a regulated utility like TXNM?
A regulated utility has a set profit margin allowed by the government based on that rate base we talked about.
So it is very predictable.
Extremely predictable. A merchant generator, on the other hand, sells power directly into the open market.
Like selling a commodity.
Yes. Their profits depend entirely on the price of electricity at that exact moment. If it is a hot summer, they make a fortune. If it is mild, they struggle.
So one is a bond-like steady return, and the other is a true commodity play.
Correct. And companies like NRG Energy, ticker NRG, are merchant generators.
So they are more sensitive to power prices.
They are much more volatile. So when the market mood swings toward the safety of regulated utilities...
Which is validated by this TXNM news.
Exactly. When that happens, shares of NRG can suffer on the margin.
Because it is all about relative attractiveness.
Yes. If I can get a safer return from a regulated utility that is now potentially in play for a buyout, why would I hold the riskier merchant generator?
Same logic applies to Vistra, Ecker VST.
VST falls perfectly into that same bucket. It is a straightforward rotation trade.
And AES Corporation, ticker AES.
AES as well. Investors rotate their capital, they go long the regulated utilities, and they short, or at least they underweight, the merchant power producers.
Now, there is another group of losers that is a bit more nuanced.
The strategic utility buyers.
Right. The public competitors to Blackstone. Let us talk about them.
This essentially boils down to a valuation problem. Think about NextEra Energy, ticker NEE.
They are a massive public utility holding company.
Right, and they typically grow their business by buying up other regional assets.
But if Blackstone is out there paying top dollar...
Exactly. If private capital like Blackstone, KKR, or Brookfield keeps winning these prized assets, they raise the price tag for everyone.
They raise the valuation benchmarks for the whole sector.
Which makes it very expensive for a company like Dominion Energy, ticker D.
It makes it very hard for Dominion, or NEE, to buy assets accretively. Let's define accretively for the listener, meaning they cannot buy a company without hurting their own earnings per share.
Right. If the price is constantly bid up by private equity, a public company might actually destroy shareholder value by trying to match that high price.
Because they are using different money.
Private equity has a totally different cost of capital and different return horizons. They can afford to pay a premium that a public company like Dominion simply cannot justify to its everyday shareholders.
It really limits their organic growth options.
It does. It forces them to rely more on internal growth, building out their own existing assets, which is a much slower process than just buying a neighboring utility.
And Southern Company, ticker SO, would be in the exact same boat.
SO faces the exact same dynamic. If the private markets are consistently willing to pay a premium, the public strategics just get priced out of the M&A game.
They cannot compete for the best assets without diluting their own earnings.
So, in a strange way, Blackstone's regulatory success today is a major headache for the corporate development teams sitting at Southern Company or NextEra.
It is fascinating how one headline touches so many different business models.
It really is.
So let us break down the specific trading angles to watch here. We have the news, but how do you watch the market react in real time?
The very first thing to watch on your screen is the spread on the TXNM deal itself.
Okay, we know FERC and the antitrust review are cleared.
But you have to watch if the stock price moves all the way up to the offer price.
And if it does not, let us say there is still a gap.
If TXNM does not move much closer to the implied takeout value, that is a warning sign.
It signals that the market thinks other remaining approvals are still a blocking factor.
Right. Maybe traders think a state-level regulator in New Mexico or Texas is going to create a problem.
So you constantly watch the gap between the current trading price and the actual buyout price.
Correct. The tighter the spread, the higher the confidence. If the spread remains wide, despite this great federal news, the market is telling you it is still skeptical.
And for the sympathy plays we discussed earlier, like AVA and OGE, what are we looking for on the tape there?
You are looking for a mild takeout premium bid.
So seeing if they pop a little bit.
You want to see if these specific stocks outperform the broader utility index today. If the utility sector overall is basically flat, but AVA is up 1 or 2%, that is the sympathy bid in action.
It is the market collectively acknowledging that they are now slightly more attractive targets.
Precisely. You can literally see the sentiment change in the price action.
And generally, we should look at the tape for that broad rotation we discussed.
Yes, look at the pairs. Are the regulated utilities getting bid up while the merchant power names fade?
Watching TXNM versus NRG, for instance.
Exactly.
Yeah.
That is the classic tape response to this kind of headline. It confirms for you that the regulated cash flow thesis is dominating the day's trading.
It really highlights how interconnected this whole ecosystem is. One rubber stamp from a commission in Washington.
And it spreads out to construction firms, competitors, and completely different utilities across the country.
It connects everything. It validates the business model for the private equity giants. It sets the acquisition price for the public utilities. And it even directs capital flow for the blue-collar contractors.
It is the engine of the market at work.
And it leaves us with a pretty compelling question for the future of the sector.
It really does.
If private capital can navigate these federal hurdles easier than the public strategics, are we looking at a future where the entire utility map is redrawn by private equity?
That is the big question traders are asking today. If they have the regulatory playbook and the massive capital, the ownership structure of the U.S. grid could look very, very different in 10 years.
Something for you to think about as you watch the utility space. Before we go, we need to handle the legalities.
Indeed, we do.
Please remember, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Always do your own research before placing a trade.
Thanks for tuning in to Breaking News to Trading Moves. We will catch you next time.